Hello? There we go. All right, thank you very much for everyone attending tonight. It's a beautiful day out there. We don't have to worry about flood insurance tonight, but it's a big issue in our area. And as I've been watching it down in Washington, and as it's been coming through our state is very important, and it's positioned where we have a lot of properties that are involved with these insurance policies. Literally 64% of our entire state is affected by flood insurance. This is a very big issue. It is causing problems with people selling their homes, buying homes. Some homes, people are reducing the property value, which in the end could cause problems with our mill rate going down. So this is a serious problem. After I looked at some of the statistics, it looks like since 1980, the government has collected about $470 billion, and as of now, they've paid out in the same time $480 billion. So the problem is that there's more money going out than coming in, which is causing the premiums to skyrocket. In the end, this is a big problem for our area on the shoreline. A lot of our homes down here were built on an 8 to 10 foot storm surge, and now the average storm surge is around 11 feet, which is a big problem with the homes that are built very close to the water, where as the sea rise and the temperature of the water goes up, the water's getting closer and there's a lot of issues. So what I did tonight is I put together a panel of speakers that have been at the state capitol. I'm also a member of the Shoreline Preservation Task Committee, which we're looking at all of these issues. And as I mentioned before, we have the 6th highest rate on the East Coast out of 18 Atlantic states with our access to these flood insurance problems. We're second only to Florida. So this is a pretty big issue with all of our rivers and lakes and ponds, and of course Long Island Sound. We have a lot of exposure, so it's time that we learn about the facts, what's happening to us, so that we can get more adjusted to this and plan for the future. And tonight these speakers have come here to bring you information. They're not policymakers. This is basically an informational meeting. We have a lot of second homes in Clinton also, Westbrook, Madison, Old Saybrook. So this is kind of our lifeline. Our industry down here is tourism, and this could definitely affect the cost of the homes, the taxes that are paid on the home. So it's a pretty big issue. Also, I learned after the last storm that if you noticed, our I-95 was closed in a couple of spots. I-95 was built years ago, and it was supposed to be the barrier to keep the wind and the rain and the tides out of the mainland. And in the last storm, there were several sections of it that were actually blocked. So this is a big problem if we have to get out, if there's a military event where we have to move our troops around, if we have to escape. By I-95 going down, it's a big problem, along with the rail. The rail was affected, it came to a stop, and this is another issue. When they built the rail, they weren't planning on such a high storm surge. So these are all things that in time will have to be rebuilt, moved, adjusted, and they're going to be very expensive down the road. I also found that with some of our power problems, a lot of the power goes through our bridges and our highway areas where we have a lot of electronics that are actually built underneath the bridges. This is a big problem, being that when they were built, we never had any idea back then that the water was going to come up this high and affect our infrastructure. So as time goes on, these adjustments will have to be made so that we can, move up, move back, and make adjustments. So tonight we have some great speakers from deep. We have Diane Ifkovic, who's going to speak about some deep issues. From the Department of Insurance, we have George Bradner, which will come on second. And from the Office of Policy and Management, we have Garret Eucalitto. From the Connecticut Realtors Association, we have Debra Chamberlain. And all of them will talk about certain issues to do with their industry. And I'd like to hand the mic over to Diane at this point. And at the very end, we'll take some questions.
Are you on the one that says flood insurance form?
I am now.
Okay, cool. No, I can't see, I'm sorry, I gotta
That's
check
okay, don't
everything.
worry about it. Just say that.
Thanks for the introduction. My name is Diane Ifkovic. I work at the Department of Energy and Environmental Protection. I've been an environmental analyst there for 16 years in the flood management program. Our agency is the designated National Flood Insurance Program Coordinating Agency. I'm actually the state's National Flood Insurance Program Coordinator. It's kind of like a ceremonial title. It's not a real state title. It just means I'm the contact person in the state between FEMA and, say, the towns for flood insurance, and also you residents for flood insurance issues. Tonight, I'm kind of probably the more boring slideshow. I'm going to talk about the Homeowner Flood Insurance Affordability Act of 2014, which was just passed in March. You can go to the next slide. So I'm going to kind of just try to set the stage. What's been happening with the flood insurance program in the last couple of years. There's been a lot of changes in flux. You're probably aware of it, and that's why you're here. So I'm going to start kind of like back in time and then move forward, as succinctly as possible. For those who don't know, the National Flood Insurance Program was established by Congress in the late 60s. It is a federal program. It's run by FEMA. It used to be actually run by HUD when it started, because there was no FEMA. FEMA makes flood maps. FEMA sets minimum flood regulations that communities adopt, and they also set the insurance rates. So we, again, at the state and even at the local level, are kind of in the middle of the process. It comes down from the federal government. The biggest component of this, and probably is what you all realize, is it's a federal law that lenders, and this is credit unions, banks, etc., if you mandate that you have flood insurance for a mortgage, and that also includes a reverse mortgage, a home equity line, any kind of building loan where the home is the collateral. If you're in the mapped floodplain, you're mandated by law, by the bank, which is mandated by federal law, to carry flood insurance, much like you're mandated to carry homeowners insurance. So that's usually where everybody cares about this, is when it has to do with a lender's mandate. Currently, every Connecticut municipality participates in the National Flood Insurance Program. It is voluntary. A town does not have to do it. We are probably one of the rare states that has every town. We have 177 jurisdictions, so it includes, say, the borough of Stonington, the town of Stonington, the borough of Fenwick, and Old Saybrook. They're actually two separate zoning jurisdictions. We have about 43,000 policies as of February of this year. We've gotten paid out almost $490 million in claims since 1978, so that's just calculated. So a lot of that is Sandy, it includes Sandy. Go to the next one, please. So I'm just going to go over two terms so you understand as we're going. Again, I'm trying to set the stage of what this is all going to mean to you. So there's two important terms for you to remember. Pre-firm versus post-firm. The word firm means flood insurance rate map. Those are flood maps. FEMA makes them, the towns adopt them and use them for building codes. Insurance companies use them for rating. Pre-firm means the home was built before the very first flood insurance map was given to the town. Most towns in Connecticut joined the National Flood Insurance Program somewhere between 1977 and the early 80s. Again, it's a different date for each town. So if you have a house that was built in 1950, 1960, 1800, 1776, etc., you are pre-firm, meaning you were built before there were any codes and any maps, and you're probably built out of compliance. And then you have post-firm buildings. So those are buildings that were built after the first map and regulations that are supposedly built to code, to flood code, okay? And again, that kind of changes over time, but you were built at least to whatever was in the code enforced at the time. The thing you have to remember here is pre-firm structures, because FEMA realized They didn't want to penalize you. When the program first started, they realized, if they charged you a real rate for that building, it would be a very high rate. So what they gave you was something called subsidized rate. So it's an artificially low rate. It's not an actuarial rate. Post-firm structures, because they're built supposedly to code, do get actuarial rates. So that's just an important thing to remember as we keep going. Go to the next one. And there's another thing that has changed or was proposed to change, something called grandfathering. Again, it's kind of similar to the pre-firm, post-firm scenario. The maps do change over time. If you started in the 70s, probably Clinton, and I know in the last couple of years the flood maps have changed definitely in this area at least twice in maybe the last 5 years. So they do change. So say you bought a policy, say you lived in the floodplain, and then all of a sudden you ended up in a worse zone. If you had a policy, it didn't automatically put you rating-wise into that worse zone. They let you keep that old zone for rating purposes. Similarly, if you were outside the floodplain and you had a policy just by happenstance, or you were astute enough to buy one before the map came into being, you would keep that old zone for rating purposes, not the premium, but the zone. So that's grandfathering. So as long as you don't let the policy lapse, you keep that old zone for rating purposes, even though, say, you went into a worse zone. Does that make sense? I hope that makes sense. It was a way to save money and to, again, not penalize people. All right, you can go to the next one. So now we get to the Biggert Waters Flood Insurance Reform Act of 2012, or something called BW12. It was signed into law in July 6th of 2012. And as Representative Vicino did say, a huge component of it, reason why it was signed into law, was because the program had become financially unstable. It was incurring $24 billion in debt. A lot of it was from Katrina, Irene, Sandy, other storms, and over the years, the program has been able to take on some debt, borrow money from Congress, and pay it back. At this point, they weren't able to do that. It was just such a large number than before. Congress started to ask questions about the program. It's about 40 years old at this point. And then they started to say, well, they thought they needed to make some changes. So the big targeted changes were, again, getting rid of these subsidies, these grandfathering things, because this is the way the program was losing money. They felt that after 40 years of subsidized rates, it was time to start moving people to an actuarial rate. So that was what was going to happen. And I say this only because this is going to change 3 slides from now. So keep this in your brain, but it's going to change in a minute. I was setting the stage of where this all came from. In Connecticut, we have about 45% of policies have some kind of subsidy of some kind. Nationally, it's only about 20%. Reason being, it's very similar along other states on the East Coast. We have a lot of old building stock compared to out west. We have homes from 1600s. I have one right across the street from me, 1700s. So we have a lot more older buildings, so therefore we have a lot more houses with subsidies. Go to the next one, please. So these were just some of the components of the BW12 Act. Subsidized rates were going to increase up to 25% a year for seasonal residences or ones non-primary. How do they know it's non-primary? When you fill out your application, there's a box, primary, non-primary. So you tell them that right up front. So they're just siphoning off those people. Businesses, commercial properties that are pre-firm. Again, if you rebuild the structure and it's built to code, and a good example is Dock and Dine in Old Saybrook is going to be rebuilt soon on piles. We're not talking about that one because it's a brand new building. It's these old buildings that are not built to code. Substantially improved or damaged structures, severe rep loss structures. Those are just structures that have lots of claims. These are going to be charged 25% a year to drive them to get an actuarial rate. Go to the next one, please. And this one was probably the one that was the worst, and the realtors are going to speak at the end, but this one was the one that was probably the worst nationwide. A full risk or an actuarial rate would be applied immediately, so 0 to 60. When a home was sold, some kind of change of ownership. It could also have been a change, say, of ownership from, say, parent to a child type transaction, not a straight sale, a lapse policy, or a new policy. So anytime the ownership changed, it would have an immediate full risk rate. So we had a lot of instances, and I'm sure you heard about some of these, where we had people getting $40,000, $60,000 quotes when the new owner went to go get flood insurance. Go to the next one, please. Also under this act, the grandfathering rules were actually scheduled to be phased out in October of this year. That's actually not going to happen. You're going to see that in a minute. But what it would have done is, so again, the grandfathering affects when a map changes out from under you. So anyone who got a new map, flood map, after July 6th of 2012 would have been affected. In Connecticut, every coastal town received a revised flood map last year, from Greenwich to Stonington. So if you were outside the floodplain and then suddenly you were going to pay that rate. If you were already in the floodplain and you went to a worse zone, so say you had built the house 2 years ago, it was in an A zone, and then suddenly this map told you you were in a V zone, you would have been charged a V zone rate. So that could be a pretty substantial difference. They also tacked on an additional 5% fee of your premium for a reserve fund, so again, kind of a piggy bank, a emergency slush fund. What it also did, and this is probably the one at the very end that affected everybody, even those people who were post-firm people. It used to be that FEMA could not charge you no more than 10% a year per zone. So an A zone might be 4%. Kind of think of your normal increase you would get every year with your insurance. You'd get a few percent, 3%, 4%. It would be no more than 10. This act drove it up to 20%. So the cap went up another 10%, so you probably were getting double-digit increases. And that's probably what you saw last year. The vast majority of people were going to see that, the double-digit increase. And they were going to do that for 5 years, and I kind of lopped this off to make it shorter, until again, they were driving you toward an actuarial rate. Go ahead, you can go to the next one. This is a quick example of maybe what a subsidized rate would look like. Okay? So the top one would be an example of a pre-firm house. No matter how low or high you are, it's the same. They're trying to equalize you. Go to the bottom one, so say that's an actuarial rate. So think if you were a pre-firm house and you started to go toward an actuarial rate, as you get lower and lower in the floodplain, because you're supposed to be built higher, the rate is going to go up. Okay? It's just an example, it's not like the rule for everybody. Go ahead, next one. And with all the things I just said, probably the biggest pushback was from realtors and those trying to sell homes, because when someone goes to buy your house and they get a quote for $40,000, it probably is almost impossible to sell your house. Again, unless you have somebody who's paying cash and they don't care, which is probably very few people. So there was a huge pushback in Massachusetts, Connecticut, especially New Jersey, because they were very affected by Sandy, and this kind of added into their whole issue down there. They realized that there were some things they needed to tweak on that last bill. So in March of this year, so practically 2 months ago now, the Homeowner Flood Insurance Affordability Act of 2014 was signed into law. So basically what it did, it didn't totally repeal that. It just basically modified it and repealed parts of BW 12. So we're going to just quickly go over that. 18% per year is the cap on a piece of property. You can't go any higher than that. It does not change the requirements for secondary houses or commercial properties or severe rep loss properties. They are still going to get 25% a year. So if you have a lot of secondary homes, and I just spoke to somebody in Clinton literally yesterday with a secondary home, and they were wondering what to do because of this 25% increase. That is still in play. So, go ahead. What it did repeal was that new policy, sold policy, lapsed policy provision. So if you are selling a house and it is an older house, you're going to go back to that whole grandfathered old rate structure. We are hearing problems right now of people in the middle of trying to sell the house, and again, some agents haven't It takes time to get all these rate things straightened out, as probably George knows. We'll have to talk in a minute. But they said it might take, say, 8 weeks, 12 weeks to get this fixed. In the meantime, people are being allowed to transfer old policies to new owners. It also restores grandfathering, so all that business that would have happened in October isn't going to happen. They just won't implement it. So there wouldn't be any rate increases there. You are going to get potentially a refund for anyone who overpaid. That really only applies to those people who were those new policies getting instantaneous actuarial rates. It was if you've got those normal rate increases we talked about, you're not going to get a refund. So it's a very small group of people. If you bought a new house and you got an actuarial rate, you're the one who's going to get a refund. Instead of that 5% kind of reserve fund, they're just going to do a surcharge, 25% for residential and $250 for a commercial property. And FEMA's going to perform an affordability study and a goal system, try to phase this in with a little bit more, over a greater length of time that's a little more manageable for people. You can go to the next one. So basically, this doesn't necessarily get rid of the problem of rising rates. It's just going to extend the time frame. Like before, they were going to do 20% a year over 5 years to try to drive you fairly quickly to an actuarial rate. Now, instead of 20% a year, they're going to make it go down to up to 15% a year. So it kind of fell between the 10 and the 20. The old system was 10, the new one was 20, so they cut it in half and went in 15. And there's no time frame. So before it was over 5 years, now it's just indefinitely. But the point is they're still going to be doing it to get you to be actuarial. And they are required now to at least raise your rate at least 5% a year. So you can go to the next one, last one. And Representative Vicino basically already said all these things. It does extend the time frame to phase in the rates. The rates aren't going to go down. It's going to be over a longer, more drawn-out period of time. It does provide some relief again to those new home sales, remapped properties. But again, eventually it's going to catch up with those people too. It has a lot of uncertainty for people, selling houses, buying houses, decreased property values, decreased grand lists. We're already hearing that from some other towns who are having trouble. I've heard it from Milford, trying to sell houses. Their grand list has gone down this year because of that. So, and again, the potential inability for people to pay a higher premium, as time goes on. You can go to the next and last one. That's just my contact information. That's it.
All right, Diane, thank you very much. Our next speaker is George Bradner from the Connecticut Insurance Policy, here to bring you up to date on some current, past, and future issues with flood insurance and how it impacts our local area. George?
Good evening. Hopefully after I'm done and Garret gets done, you'll have a little bit of a ray of sunshine of some possibilities that to look forward to. As Representative said, I'm the Property Casualty Director for the State of Connecticut Insurance Department. I also have a couple other roles with the state. I serve as the state's, for the Insurance Department, working with the Department of Emergency Management, Homeland Security as in their advisory capacity on their council. I'm also the co-chair for the state's long-term recovery committee, which we started up about 2 years ago, and hope to maybe come back to Clinton to talk to folks in Clinton further about what we're trying to do on that side. I serve as the co-lead for DECD, Department of Economic and Community Development, with DECD, that's the Department of Economic and Community Development, on Sandy recovery initiatives, and report to Deputy Commissioner Shea at the Department of Emergency Management. This evening, I'd like to discuss with you our risk as a state as respects to recent catastrophes, NFIP, and flood. Next slide. I can't see them, so you're gonna, okay, hit once and we should see coastal property. You'll see that in Connecticut, this is what keeps the industry up late at night. They see Connecticut, and there's $480 billion of property that's personal and commercial property exposure just on our shoreline. Next slide, or next, just hit next. Rep. Vinzano talked a little bit about this. This is a really astounding number when you think of it. Value of insured property comprises 64% of all insured property in the state along our coast, and we're only second to the state of Florida. And trees, hit next. Trees, we found out with our nor'easter that we had in 2011, while we love our trees, they are also our Achilles heel. Next slide, please. These are the events that we've had since 2011. We've seen numerous storms. Frequency and severity of the events are increasing. They've crystallized the importance of the state being prepared and the importance of long-term recovery. Next slide, and hit it twice. I want to sort of go over the numbers from an insurance perspective for Sandy and Irene, the nor'easter, and if we remember, the winter of 2010-11 was also quite hard. The industry from these 4 storms has paid out close to $1.1 billion in Connecticut alone. For Sandy alone in the region, and looking at New York, New Jersey, Connecticut, and Rhode Island, there were over 1 million claims and $9.3 billion paid out from Sandy. Next slide. And I forgot to tell you, I have a little bit of interaction here. There's a question. And I'd like to ask people this. Were Sandy and Irene hurricanes?
No.
Thank you. Next slide. Hit next. No, they weren't. And I think that's something we need to keep in mind when we look at those storms and how they impacted the state. They were not hurricanes, and that's what we need to, as a state, to be prepared for when we do get that hurricane 1, 2, or God forbid the 3. But we have to be prepared. Next, NFIP facts. This one at the bottom I think is very important. FEMA and NFIP developed their own rates. I'm going to get into that a little bit later. You're going to find some very interesting information. Hit next again. NFIP, as Diane said, it's a federal program. Hit next. It was created by Congress, and FEMA produces flood maps. So we can go on to the next one. We should be looking at Connecticut flood facts right now. Is that up?
Yes.
Okay. As Diane indicated, 45% of Connecticut properties are subsidized. And one of the things I looked at when Biggert Waters was being introduced in Connecticut is, and these numbers were thrown out, since 1978, Connecticut has collected $469 million and paid out $484 million. Now, if you back out Sandy, where the state paid $242 billion, these are geeky numbers, I'm sorry. What I try to show folks here with these geeky numbers is without Sandy, from 1978 until 2012, Connecticut had a pure premium loss of 54. So if you added a company's expenses, that means the company's paying 54 cents on losses. You add their expenses in, on average, 40% if companies were doing business here. The air conditioner shut off. You add 40 points to that. That's like a 94% loss ratio. You look at their expenses. Industry would be making money on that business. The problem is with FEMA and NFIP, they don't look at a state's performance. They're looking at their national performance, and as we've all heard, NFIP is $24 billion in the hole. So the federal government has to look at this and say, we need to make up for what we're losing in Katrina, Rita, you think of all the floods that happen along the Mississippi River, North Dakota, repetitive losses in those states drive a lot of the federal program's deficit. Connecticut doesn't, and that's an important fact, and I think that's what, when I talk about private flood, there is an industry, there is someone that's starting to look at this and think that they can get into this market and write private flood insurance. Next slide, please. One of the things on the last slide, one of the things I think is critical though, that we need to point out, and we need to get more people engaged in purchasing the flood insurance. The Northeast does have one of the lowest take-up rates when purchasing flood insurance. It's at 25%. So we do need to figure out how we encourage more people to purchase flood insurance. And maybe I'll talk to you a little bit tonight about unmet need and what you as residents could potentially face if you're in a flood zone and you don't have flood insurance, or even if you do have flood insurance and you have to do certain things that are required once your property has been damaged more than 50%. These are Sandy numbers that we are showing right now. Individual houses, when there's a disaster, like Sandy, we get a presidential disaster, and the first thing FEMA comes in to do is determine if there's going to be what they call a PA, public assistance need is met, and then an IA, individual assistance need is met. That first one, individual assistance, is where FEMA will help individual households, and they have this whole process of determining how they're going to, how a state meets that requirement. Connecticut did for Sandy. We did not meet it for Irene. So when you look at the individual assistance, there was 2,900 eligible applicants and $15 million paid. That's on average about $5,000 for the individual. Now, at the bottom of that slide, you'll see there's a number, 31,900. That is the maximum amount of money that an individual family can qualify for under FEMA. That's not a lot of money when you're looking at some significant loss. And it takes a lot for everyone to get to that. So if you see the 2,900 applicants, we only have had 38 awards, total awards meeting that $31,900. The thing I always try to tell people here is FEMA's goal is not to make you whole. They're there to come in there and try and brush you off, stand you up, and get you moving forward again. And a lot of people have this big vision that FEMA is here and they're going to make me whole and everything's going to be good at the end of the day. And I think it's good for people to realize that that's not their objective. NFIP, the flood program, it's very important to understand your flood insurance policy versus your homeowner insurance policy. When you look at your homeowner insurance policy, you see a coverage limit of $400,000 for coverage A. So if that house burns down or is blown away in a storm, your insurance company is there, and the goal is to try and make you whole at the end of the day. Do whatever they need to do to get you back into that house in the same condition that it was before the loss. NFIP doesn't necessarily work that way. They go about settling their loss on what we call replacement cost minus depreciation. So they depreciate that loss. So if you're looking at $250,000 on your policy limit, keep in mind that the average payout for flood is about $42,000 to $48,000. So the likelihood of netting a $250,000 paycheck on that claim is very unlikely because of the exclusions that they have in the contract and the policy limitations. And they settle based on a depreciation amount, where your regular insurer doesn't do that on your homeowner's policy. And we call that in the industry, unmet need. The other thing, you see the FEMA number, or you see the NFIP numbers there, average of $42,800. You need flood insurance, because if you didn't have flood insurance and you were hit by a flood, that's your bogey, I call it. That's what you would have to pay out of pocket. That's your unmet need. Now to take and add on top of that, if you had more than 50% loss to your property, you could now be subject to having to elevate your house. And an average elevation cost is about $7,000 to $10,000 per foot of elevation. So if you're elevating that house 10 feet, you're looking at $70,000 to $100,000 of elevation. And now you're looking at, if I don't have flood insurance, I have $42,000 or more or less there. So these are things to take in consideration. The other thing, how many of us have basements? And how many of us have finished basements? Show of hands. You have finished basements? All that's not covered under your NFIP policy. All they cover are the electrical and your heating system and your washer dryer. So these are things that you need to sit down with your agent and understand what is covered, what isn't covered, and then do an assessment of, you can call it your unmet need, or what's your uninsured risk. But these are the conversations we really need to have with people so they truly understand the policies that they have and what they have coverage for, what their risk is at the end of the day. Next question, next slide. We're going to hit this a couple times. It's another question, another more time for interaction. Does your homeowner policy cover flood insurance? Don't hit it yet. The answer? Good. Glad to hear that. The answer is no. Here's a statement you hear many times, and this is a very important statement. It should be saying right now, I live outside of a high-risk flood mapped area, and I don't need flood insurance. Is that what it's saying? Hit the next fact. People outside mapped high-risk flood areas file nearly 25% of national flood insurance claims. That's a high number. So don't think that you're not prone to it. Next slide. I like this slide because as I go around the state and I talk to people about long-term recovery, these are the emotional phases of disaster. And our goal with long-term recovery is where you see that sharp decline down and then the long, steady decline. You know, people don't understand, you know, the press is there the day after the storm, and there's all the media around covering the storm for probably the first week after the storm. What people don't see are the people down in Cozy Beach, in East Haven, the people in Milford that are still not in their home. And recovery takes years. And our goal from a long-term recovery perspective is how do we shorten this dive? How do we work with communities to be better prepared and plan and shorten that so that the pain is not as severe, the community becomes more resilient, and the community recovers more quickly. Next slide, please. These are the challenges that we have as a state. I like to say we have 169 chiefdoms. It's called home rule. So every town has, decides how and what it wants to do. Public policy is, incongruent with community resilient needs at times. Different zoning standards. In every town along the shore here, you will find different zoning standards in those towns. One of the things we're working on with long-term recovery is that we want to identify a long-term disaster coordinator in each one of the DEMIS regions. And then at the town level, we want a long-term recovery manager so we can work right on down into the town and help towns begin to plan and prepare and develop strategies to become more resilient. We want to educate the public like we're doing tonight, talking about NFIP, understanding what the policy covers and what the limitations are, why you need it. And then manage expectations on how FEMA and how NFIP work. Next slide. Here's our risk. This was just an article that was in the CNBC just a week ago. It's kind of discouraging. It's, when we think about it, truly, I'm going to show you some slides, and we do know for a fact that sea level is rising. Since 1900, it's risen 20 centimeters. Doesn't seem like much, but if the Arctic is melting and it starts melting rapidly, we're going to see even a more rapid acceleration of sea level. The thing is to keep in mind, FEMA and NFIP do not consider rising sea level in any of their modeling. So when you're looking at elevating your house one day or what you need to do, I always encourage people, go above the minimum standard. Don't go with the minimum standard. Next slide, please. We're going to hit, this is a very interesting slide. Hit once, and you're going to see an old topographic map. And this is the old Griswold Point Rock. And some of you may have even seen, there's an old Victorian painting with some ladies on the beach with their parasols, enjoying a beautiful summer day with their kids playing in the sand, and this rock that is well above the water line. Next slide, please. Phase forward 100 years to 1990. This is the rock, if you can see it out there, it is well out in the Sound. To me, you don't need to have science tell you that something is happening here. Next slide. Good old Sunset Beach in Branford, Connecticut. This is an old postcard. Sea level rise happens so slowly, people don't realize it's happening. It's a generational thing. And if you go to the next slide, you'll see people just sort of adapted. The water's rising, but they just built a seawall, and they're just sitting behind that rising water. Next slide. Our coastline. Every state has experiencing flooding, flash flooding. We're seeing far more flash flooding with rain events these days. Just the last couple of weeks, we've had significant rain, and we're seeing areas that are flooding with much more frequency. Towns should look at their zoning requirements and determine where they want to have higher standards than the minimum requirements. By adopting higher standards, they can preserve their real estate markets and housing values, as this will help make their housing markets more attractive to prospective buyers and help maintain the town tax records. What are our risks? Next slide, hit once. It's going to say, what are our risks? Next slide. Floods are not going away, we're seeing it. And the next slide, one thing I find very interesting, we used to talk about a 1 in 100 year event. Now these events are happening 1 in every 50 years. The frequency and the severity of these events are increasing. Connecticut has had 9 federal disaster declarations in the last 20 years. Guess how many of them have occurred in the last, since 2011? 5. Here's what one town's doing. Next slide, please. Old Saybrook. They've made a change. They've changed their zoning to require that a person that, right now, all new construction must meet flood ordinance standards. But some of the things that they've done is that if you're in a VE zone, a high velocity zone, that means you're right. Basically, a VE zone means that you're going to have, when there's storm surge coming in, you're going to have the potential of 3.5-foot waves on top of that surge. So that's a VE zone. And you have to build, when you build in those areas, you have to build 1 foot above the freeboard, they call it. I would recommend going higher, especially when you're thinking about 3.5 feet of wave on top of a surge. So what they're saying now is if in the AE zone, which is right behind the VE zone, they are going to require residents in that zone to have the same building standard requirements as a person in the VE zone. Building code changes, 2009, International Residential Building Code. Are we on that slide? Thank you. Connecticut has a windborne debris region, areas south of Interstate 95, in the following towns. And I'm not going to say all the towns, but basically from Madison all the way up to Stonington. That is an area where it's determined in those towns they can have winds exceeding 110 miles per hour. So in those towns, on the next slide, in the recently adopted 2009 residential building codes, new construction or people that are modifying their home with more than 50%, and that's over a 10-year period, they will be required to, if they're going to do a brand new home, they're going to need to have within a mile of the shore impact-resistant glass, or they're going to need to have pre-drilled, pre-cut plywood at least 7/16 thick. I would say I'd go with 5/16 or 5/8, not 7/16. 5/8 is much stronger. But that will be the requirement for new construction in Madison all the way up to Stonington within a mile of the shore. If you are elevating a home, you should make sure the home also is protected from the wind. I know there's a lot of talk about, we're going to elevate homes, but I try to tell people, okay, you've eliminated one risk, but now you've created another risk, because now that home will be completely exposed to hurricane force winds, and you got to make sure that you do, have the straps on the roof, have the building secured firmly to the piers, and then make sure you have those windows protected. Private flood insurance. Biggert Waters did introduce a new concept that Congress did want to try and see if they could get private market involvement. So they created a mechanism within Biggert Waters, which is still there, where the industry can now come in, if they wish, and have a private market flood insurance policy. We do have a player that has come into Connecticut and is looking at writing private flood insurance. It's through, next slide please. It's through what we call, I hate to get into insurance terminology, but it's through an E&S market, excess surplus lines. And it's through Lloyd's. Lloyd's has been around longer than our Constitution. So Lloyd's is a very stable, strong organization. They are the underwriters of this gentleman's product. These are the requirements that he has for his product. It's available for single-family dwellings and 2- and 4-family residences. Available for over 5 multi-unit residential dwellings. Available for commercial buildings and with replacement costs under $5 million. Available for A and B properties. Target markets, all FEMA premiums in excess of $1,000. And then the other thing is non-primary residents, going back to Diane's comment regarding secondary homes and people with secondary homes seeing a 25% rate increase every year. FEMA's going to do that, and that's one of the things that, as she said, it's not getting to actuarially sound based rates. FEMA's going to do that, and they need to do it to make up for what they're losing in other states. So if we could get FEMA or NFIP rates, I often tell people if NFIP had to file their rates in Connecticut with my department, we would disapprove the rates because we would say your rates are excessive at this point. On the slide I showed you with the pure premium loss ratios, when you add Sandy in, that did bring the loss ratio up to 103 before you added company expenses in. So with that, I try to help people understand is what that shows you is that a company needs to have profits, strong profits year in and year out, because one event can wipe out all those years. 34, 36 years of profit is wiped out in one event. So after that event in Sandy, if the company had to come in and ask for rates from us, we would probably say, yes, you can get rates because you've lost, you have a huge loss and you need rate. And you also need to consider sea level rise, frequencies increasing, and so rates are going to go up. Next slide. Do stronger building standards work? I love this slide. This is Ike 2008. Texas has the worst building code requirements in the country. You can just slap anything up in Texas and they don't care. And it's recognized for having the worst building standards. This gentleman must have been an insurance geek because he went well above the standard. And to me, there's 3 stories here, all right? There's the fortified construction and building above standard, it works. But what I also look at here is the community involvement is critical, because I would have rather seen a lot of people in a community doing what he did, because what do you think happened to the value of his property? All right? What happened to that community at the end of the day? Just what are the economic impacts to that community? So, so to me, it just shows one person can do it, but it does, a community needs to be involved in this process, and I hope, we get more and more communities becoming more proactive. Next slide. Stronger homes make a stronger market. Fewer losses, carriers stay in a market, accessibility and affordability. If you don't do anything, you have high-risk areas, you deal with higher premiums, carriers leave the market, you have fewer choices. You as consumers have fewer choices. So I think we're at a juncture now where we can do things and we need to. I think we can't say, well, it's not going to happen here. We've seen it happen twice, and we got lucky in my mind because we haven't had that hurricane, and I pray that we don't. But let's be ready for when it happens. I'll turn the mic over to the next speaker. We'll do the introductions. Thank you very much.
Okay, I'd like to introduce Mr. Eucalitto from Office and Policy and Management. Thank you.
Okay, my name is Garret Eucalitto. I don't have a slideshow. It's going to be pretty brief. I work at the Office of Policy and Management. I am working with the Department of Housing and the Governor's Office to stand up a program called the Shoreline Resiliency Fund. Back in October of last year, the Governor announced the creation of this program using bond funds from the state to establish a low-interest loan program for homeowners in Connecticut who want to elevate their homes. At the time, we were very worried about Biggert Waters. We knew a lot of people have second homes. They may not be able to get certain types of assistance from the federal government because second homes are oftentimes not eligible for that assistance, as we saw following Superstorm Sandy. The governor, heard from a lot of people who want to stay in their homes. They can't afford the rising flood insurance premiums. So by working with a nonprofit lender, we hope to be able to use state funds, give out low interest loans, let the people pay them back over about a 10-year period, elevate their homes, also do some of the wind protections that George mentioned, which are going to be critical once you elevate your home. Last month we did close on a request for proposals from nonprofit lenders who want to offer this loan program using state funds. We did select a lender. We're in the process of negotiating a contract with them. So we should be finishing that negotiation soon. In the next couple months, we'll announce the application materials. We have some idea of what it's going to look like. For instance, we know it's going to be around the 3% interest rate, which is lower than the industry average right now. It will be a 10-year term. We believe it will be no payments and no interest accrual in the first year. We know certain homes are going to be more expensive than others, so we're going to put a cap of around $250,000 to $300,000 maximum for the loan amount. If we allowed $1 million loan, it's going to sap all the money we're going to put into this. At the end of the legislative session this year, the legislators, at the governor's request, did approve a $25 million authorization to boost this loan program. We're going to work with the lender, have the lender go out to the private market, get some interest from the banks who want to also invest in this. So we'll be able to leverage the state investment with private investment to increase the amount of money we have to lend out. It's going to be only open to people in the velocity zone, zone VE, as well as coastal zone AE. It's going to be going forward, we probably will open up to riverine properties because we know a lot of people on the rivers are also having problems, but right now the biggest threat is to our coastal properties. We want to attack them first, get anyone who wants to elevate. You will need flood insurance, you have to be a Connecticut resident, those kind of parameters. That's the low interest loan program that we are creating. It should be available soon. At the end of this, I can give out my business cards, also take down your information, and as soon as our application materials and our announcement is out, I can send you an email, call you, send you whatever you want to let you know how to apply for those low interest loans. On the same note, the federal government does provide some funding to the state, which can help elevate your home. There's a few different programs. First program is called Hazard Mitigation Grant Program. After Superstorm Sandy, we did receive some money from the federal government. That application period is closed, but we do routinely receive additional funds. You would apply through your town for the funds. The town then applies to the state government. The state government then sends it up to the federal government. The federal government either approves it or does not approve it. There is another program called Flood Mitigation Assistance, which can be used for structure elevation, dry flood proofing, property acquisition, and then some other minor localized flood reduction projects. This is currently open, so if you are interested in this, I have a handout I can provide you after as well. You have to apply through your town as well, and the application deadline is June 13th, so it's a tight window. It is a national competition though, so you will be competing against people all across the country. We don't get our set pot of money in Connecticut. You have to compete with other states. The final program, which doesn't necessarily focus on individual homes, but in the town of Clinton and others may be interested, it's pre-disaster mitigation. It's for some mitigation work, mitigation planning, infrastructure retrofit, soil stabilization, and some generators for critical facilities. We know some emergency operations centers have applied for this in the past. So that is my quick presentation. Sorry I don't have as lengthy a presentation, but hopefully, the state government doesn't have much control at all over this federal program, National Flood Insurance. The governor recognized that. The Department of Housing, Commissioner Klein recognized that as well. That's why we are creating this Shoreline Resiliency Fund, which will hopefully be a state answer to a federal problem. We know it's not the perfect answer, but for people who don't have any other solution, hopefully you can use this loan program to elevate if in the future you do want to sell your home. I know there's been some interest from realtors to help people elevate their homes. We don't want to see people moving away from the shore. We love our shore in Connecticut. We want you to stay on the shore in Connecticut. It's part of our blood. We just hopefully we can stay here as long as possible. Thank you.
Thank you. That's some great programs to help you before the storm hits the property. The government looked at it and assumed it was better to have programs before the storm, being that they were paying out so much after the storm. So this will help homeowners keep their homes safe. Our next speaker is the president of the Connecticut Realtors Association, Debra Chamberlain, and she'll talk about her industry of real estate and how it affects the real estate industry. Thank you.
Thank you. I'm just curious, show of hands, how many people here live in a flood zone? Raise your hands. Oh, okay, well, good news, you're not alone, so do I. So I live in Groton, in a lovely place called Mumford Cove, and when I built my house 12 years ago, squarely at the 10-foot mark with a finished basement, thank you very much, and a nice big TV down there, I, of course, like many of you, just never saw this train wreck coming. So at the end of the day, I've learned an awful lot. And as the president of this association, I've had an opportunity to get out in front with Representative Vicino and the Shoreline Preservation Task Force and many of the folks you see here at this table. We have been working diligently at the state and federal level to try to understand the issue and to try to find out how are we going to solve the issue to the extent that we can keep people in their homes, keep them safe, and not have our market on the water and on the streams crash and burn, which is kind of what has been happening up until the last few weeks. So let me give you a little bit of history here. We were very involved in the Biggert Waters Act way back when, and as part of my job with the association for many, many years now, I have had the pleasure of dealing with our state legislature as well as our federal legislators. In terms of lobbying discussion, we're sort of the voice of real estate, if you will, and we have a very strong lobbying group out of DC. And so we have been, for a number of years, working with them on this issue, and when the NFIP program ran out of money a few years ago, it happened very quickly and very quietly, and all of a sudden we had closings. Some of you may remember, you may have been one of those affected people. You thought you were going to sell your home, but we couldn't because we couldn't get flood insurance. They ran out of money. So at that point, we went into high gear, and that was the Biggert Waters Act. Now, with any piece of legislation, it starts out about this thick, and by the time we finish getting what we want, it's about 2,000 pages deep, sort of like the healthcare reform. And so it becomes something other than what you started out hoping it might be, but it's the best of what you can get, and it needs to happen. And so that's really what that was the beginning of the conversation. And a lot of good came out of that. We funded the program, we saved the real estate day, but then the unintended consequences hit, and you heard all about those up here. And so then the realtors went back into action, and we went back down to DC and back up to Hartford, and we have had an open door. I have to tell you, your legislators in this state have welcomed us with open arms. We have been sitting at the table with them, literally voicing your concerns, and it has made a huge difference because that's where that Affordability Act came from. And out of that came a lot of really good changes. Now, last week I was in DC for the entire week, and I have a funny story to tell you. One of the meetings, the many meetings that I was in last week, was with FEMA. And we had 4 representatives meeting with us from FEMA to explain to us, the realtors, how it was that they were going to implement the many things they were supposed to be doing under the Affordability Act. And we have been very firmly, but nicely, sitting on top of them, to tell them, you've got to get this ball rolling, you need to implement these refunds, when are you doing this, don't tell us you're doing it in 20 years from now, we want it done yesterday. So they had a panel of 4 esteemed folks who were going to come in and fill us in on every detail. And you may recall the weather last week. It poured rain in DC. They had 5 inches of rain the day that FEMA was supposed to show up for the meeting. And I have to tell you, we sat there because they were late. And when they got to the meeting, they looked at us and they said, "We're really sorry we're late." They never even thought about what they were saying, but we got stuck in flooding. And I thought to myself, well, isn't Mother Nature just have a great sense of humor here? So it was kind of interesting to me because I think for them it was sort of like, oh, flooding's not a lot of fun, and it was a personal little experience with it maybe that they hadn't had before. But at the end of the day, we learned a lot from that meeting. A couple things that I think I wanted to point out to you that have not been mentioned yet today, little known facts about the new act. They have also put a 1% cap on your premiums so that your premium will not ever see $40,000, $50,000, $60,000, $70,000 like we were seeing before, and that's literally out of their mouths. Because there's a provision in this legislation that says that you can't charge more than 1% of the value of the property for this insurance. And so they have to structure their rating system to include that information. So that's one thing. The next thing that we learned that's very important for all of you is if you have an NFIP policy, do not cancel it, please. Because the minute that you cancel it and then try to sell your home or transfer your home to somebody else, or the minute that you go into, say, Lloyd's of London, and then decide maybe you want to come back into the pool, you're at full risk rate. And FEMA was very adamant about that with us, and a lot of folks don't realize that. We asked them to clarify that. So what I'm really saying to you is proceed with caution, because we're going to resolve this. And right now they are rolling those rates back, so you've heard that, and we've got some sanity back in the game in terms of the rating structure, and there's some limitations as to what they can do. But at the end of the day, if you leave the program and then later sell your house and try to come back in with the new people, they're going to be paying full risk right out of the gate. So they've lost that grandfathering provision. So you just want to be cautious about that. And I also wanted to let you know that on our website, Realtor.org, which is our National Association website, we have a little house. You'll see, you can't miss it. It's the National Flood Insurance Program logo. And it's very visible, and it's right there. And if you click on that link, you're going to find all the information you really need that they've gone through tonight to understand how this impacts you if you're residential or commercial or really whatever your questions are. And you're going to have a lot of other resources available to you from the National Association of Realtors that might help you ferret that out. So, what else can I tell you here? Oh, one other important note, elevation certificates. Has anybody here done that yet? Gone out and got the okay. If you are a pre-firm house, probably it's a double-edged sword, but it's a sword you have to pull out and use, because at the end of the day, the way that they're going to figure out how to stop charging you extra 18% every year, or 25% rather, is by getting that elevation certificate. Essentially what FEMA said to us is we need you to tell the public that if they're in a pre-firm house, they need to go get that certificate. It's going to cost you somewhere between a few $100s and potentially a few thousand, depending on your land. But at the end of the day, it's going to tell them what they need to know, hopefully, to decide what's the maximum rate you should be charged for that particular policy. Without that elevation certificate, the sky's kind of the limit to some degree, so you really need to keep that in mind. I'm also going to tell you that there's a company called Carolina Flood Solutions, and they did a presentation for us while we were down in DC. One of the things that we learned, and this is not by any stretch a slam on the insurance industry or anybody, because this is a very complex issue. Some of those really frightening rates we were seeing up there in Groton and $70,000 range, they might have been accurate, but there's a chance, a really good chance they weren't, because for a very long while, or a few months at least, these poor insurance agents were given very little guidance, in my opinion, and they were asked to do some very difficult rating on these properties. And they didn't really have anybody at FEMA sort of guiding the ship, if you will. And so at the end of the day, there were a lot of, we discovered through working with this particular company, there were a lot of folks paying a whole lot of money who should not have been paying quite that much money. So now they've rolled all that back and there are rate tables, and that won't happen again. They now have firm rate tables, and the bottom line is the agents are not left with the question of how much should I charge these people. So I think that that's an improvement. And I think that's really all the thoughts I had, and certainly if you guys have some questions, I'm happy to answer them, but just moving forward, you should know a couple things. Because I am the president of the association, but also because I have a personal interest in this, I will remain heavily involved in this. And our national association has put together a 25-person appointment committee. They call it a PAG, it's a presidential appointment group, so our national president appointed 25 of us from around the United States, and I'm one of them, who will sit on the group that is watching over FEMA like a hawk. So we'll be meeting with them, maybe in the rain, maybe in the sunshine, on a regular basis to say, how's it going? What are we doing with those refunds? And where are we with this and that and the next thing? And two things that they're working on that are going to take some time. They're looking at the maps, because we don't think they're accurate. We think they suddenly got a whole lot more people in the floodplain than used to be. And we also think there's some science that needs to be fixed in those maps. And so they are working on getting that study done. They're telling us they need years, like a couple anyway. And they're also working on a long-term study to determine the rate structure and what it should look like. Those are the two things that are going to take time, and they're asking us for patience. They're also asking us for patience on the refunds. They are working on it. We don't have a date on when the folks who deserve those will get those, but we think it'll be sooner than the studies will be done. So I guess that's about what I have to offer, and thank you for having me, and I'm happy to answer any questions after. My cards are here. If you want more information, the association's happy to send that off to you. Thanks.
Thank you, Diane. Does anyone have any questions? Could you'd like to come up to the microphone? Right here, this microphone.
Hi, my name is Barbara Cerruto. I live on Blake Avenue, which has never ever been in a flood zone until FEMA just redistributed the maps. And I'm representing Beachport Road Association. We are 27 homes. I probably developed in the late 40s, early 50s, and I don't think anyone has flood insurance. We have an 18-foot wall on one side of us and a 10-foot wall directly in front of us. We have never flooded. So my question to you is, if we've never had it, what do we do? Well, we probably don't have mortgages, most of us. We've lived there for very, very many years, and there might be one or two new people that do. So, of course, we're working on what we don't have a mortgage, so we don't have to worry. But I can see that that's not the case. What steps do we take? How do we proceed?
All your insurance.
No, I'm trying to think what I'm going to say.
We've never had
Do you want me to re-say the question? Can you hear her? Do you want me to?
How do we proceed if we've never been required to have flood insurance until our street was just recently?
Her street was recently remapped into the flood zone. You live in Clinton?
Clinton, yes.
Clinton in, what was the area you called it?
It's Blake Avenue.
Blake Avenue?
Right.
And so they have a couple seawalls, is what you
We
said?
have an 18-foot seawall to one side, and we have a 10-foot seawall and beach before us. We have never ever flooded.
Okay, and so most people have no mortgage, but you're worried about all the things you just heard tonight.
Right.
The coastal maps were redone last year for Middlesex County, so Clinton was in February. They were much more concerned, so you're saying you have the walls,
Right.
and I don't doubt that you haven't flooded, maybe, substantially. When they did the new maps, they used a brand new coastal model last year because they found, and again, they looked nationwide at damages, and they found that things like seawalls were not providing as much protection. Maybe, they were old, crumbly, so the model pretended that they failed. So when they do these models, do you see what I'm saying to you? Before, maybe they added a certain degree of protection. So now they've made the model pretend like it maybe was not there or less protection. So that's probably why it moved inland. So it's good that you don't have a mortgage in the sense that if you don't want to buy it, then, but as George said, and he made excellent points, it doesn't necessarily make the problem go away, but at least you have financial options at that point. One thing you could try to do there's always a mechanism called a letter of map change. They're like map amendments, letters of map amendments, also called LOMAs, L-O-M-A, or LOMARs, letters of map revision. If you feel the map is wrong, you're always able to challenge the map. Now, in this case, you'd have to go and hire an engineer who knew something about coastal modeling to try to see if the map for your area was done accurately or not. So that means it's going to cost, you know, if it's a homeowners association, maybe that's something you want to look into. Right. So if you're successful with that, meaning, you know, they relook at it. I would hate to say it's the other way, maybe it's worse going up the street. But say it was successful, so it would move the flood zone, you know, wherever it was really supposed to be. So it might move it away from you. I can't guarantee that though. You might be spending money for nothing. The only way you know that is to actually have to hire somebody who would, again, take a look at your very specific location. Because the other thing too is when they do these maps, you know, they're going miles and miles of shoreline, and often in between, they take what they call transect measurements up and down the coast. Everything in between is kind of interpolated to some degree. So you may want something that's very particular to your area, to your little neighborhood, but it's going to cost you money to do that.
But if you're successful, you get reimbursed.
You do.
That's true too, and if you're successful, you'd get, well,
Yep. Under the Homeowner Affordability Act, if you're
I know.
successful in appealing.
They said that now, under this new act, they actually did say that, but I haven't seen that, I only am careful not to say it, because I haven't seen them put it into a piece of paper yet. So that's what they said, if you're successful in an appeal, you're actually supposedly gonna get whatever the cost is back. Again, I'm always cautious about that, because I haven't seen it on a piece of paper yet, and, you know, I just don't wanna say, let's, you know, it's half her amount or whatever, and then I'm telling you, you're gonna get everything back, so, you know, I'm only being cautious with that.
So in other words, it would behoove us to get an engineer or something, and on a large scale.
Possibly. It may possibly take a good look at that spot and to correct the map.
Thank you.
Does that help? I think she's going to say one more thing.
I'm going to give you the real estate perspective, and this is where this usually comes into play. There are a lot of folks out there who are somewhat self-insured and they're in a floodplain. You don't have to have the flood insurance. You understand the risk. You can take it on. That's fine. The problem happens when and if people in your neighborhood want to put their house up for sale.
Right.
Now we have a problem because there's this big black cloud hanging over our head and there's a lot of unknowns. And so what we find in real estate is unknowns cost you money. The less the buyer knows about what the possible black cloud is, the more they're going to expect you to give in your price. And so in an effort to solve that question, I think you might want to be proactive while the legislation's favorable and find out what your rates are going to look like. You know, go ahead and call your insurance agent. I think that the map revision is not a bad idea, but it can be a double-edged sword. You might be in a worse place than you thought you were, especially if you're really close to the water. But at the end of the day, there is a provision for refunding you, and she's right, I have not seen it happen yet, but they're telling us that's the case. So, but from a perspective of selling your home, guys, the more information you can give a potential buyer, the less it's going to cost you. And the reality is, if you're 5 feet below the floodplain, well, that's just what we are. And that's not going to be a completely rosy picture no matter how you slice it. But beyond that, if you can say to people, well, this is what we think the rate's going to look like, and here's our elevation certificate to back that up, now they're not dealing with an unknown. They know that 4 years out, their premium's probably going to be this, not some unknown number that worries them.
Thank you. Next question, sir?
I'm not clear on the, I bought my house 46 years ago. And, of course, there was no flood insurance. And I've been there, I got a reverse mortgage 13 years ago in order so I could stay in the house because my income is so small, I could make it with the reverse mortgage. Then they hit me with the flood insurance. They wanted $2,500 within 45 days. I couldn't make payments. Where do you get the money from? Okay? You don't have the money. So, my question, one of my questions is, you talk about a grandfather. full rate? I mean, they're basing it, they said they were basing it on the rebuild cost of my house, which was the rate.
I'm going to let you cover the insurance side of it.
Okay.
Okay, but do you have an elevation certificate on your house? Have you ever had one done?
I had a surveyor did come out.
Okay.
I'm the only house on the street that has flood insurance, has to have flood insurance.
You are the only one.
Because a corner of my house is a swamp in the back.
Oh,
And a corner of my house may flood and come into my cellar.
okay.
And my house is up high, of course. Now, I'm paying all this money for flood
Yeah.
insurance, and they're gonna have to be $5,000 deductible.
Yes.
In order to bring the payments down.
Under the new plan, you can get up to a $10,000 deductible under the new legislation, and they're also going to let you make payments. So you will have that opportunity, but the only way you can fight the scenario you're in is with an elevation certificate.
Okay, so the realtor, I mean, the surveyor did say that according to the floodplain, it is in the flood zone. So that's it, right? Now, the other question is, we can no longer pay your flood insurance. And you're gonna have a hard time selling the house because it's got flood insurance. What do? When you have no money to go anywhere, and no money to pay the flood insurance, where do you go? And I hate to be saying that in front of everybody, but this is a problem. I'm 81 years old, and I'm scared.
Can I go back to the other one, the first part of the question, not that part of the question?
Okay.
Okay, so the part where you have the elevation certificate, right? Did they tell you, did someone actually look at that and say you couldn't do a map amendment?
I had a surveyor come out twice, they would, he would call FEMA, I had, Joe Courtney was working on it, everybody trying to
Okay.
get it out. FEMA wouldn't move on it.
FEMA wouldn't, you don't have it with you, you don't, no.
I don't even know. I'm 81 years old, I don't understand.
Would you-
the work, I don't understand.
If I give you my card, will you call me tomorrow and, because I want to look at it to see, you might actually be able to actually do a LOMA for that house. If you're telling me you're on the edge,
That's
I want to see the numbers on that.
what they told me.
Because maybe I've known surveyors, they know how to do surveying, but they don't know how to look at the piece of paper and say, oh yeah, that's gonna work. I'll do it all for you if you give me that elevation certificate. If it works, the numbers have to work. It's just a comparison of numbers. But maybe they're not looking at it in the sense of where you want to
I
be.
don't understand what that elevation certificate is. I don't even.
Just means how high your house
I don't know what it looks like.
That's why I want to see it.
Okay.
Okay? All right.
I like your card.
Okay. The other part, the other part's a harder one. I mean, it might be the fact that, this is not the house for you anymore. I hate to say it like that.
It's not the house that we got the house, because I wouldn't have any money left to buy anything.
Yeah.
Not enough income, pay rent, and it's scarce.
Yeah. I mean, that part,
And I think, and I don't understand why I'm paying so much money for flood insurance. So I'm paying $500 a year, $500 a year for homeowners insurance, will cover everything,
right.
and $2,000 a year, the most of them will pay for 60%.
Because probably the risk of your flood is almost higher than other losses.
Sir, that's what we're doing here tonight. This is an informational hearing to hear from the people. And as someone mentioned to me the other day, it's not fair that we have to have flood insurance. They don't have earthquake insurance, forest fire insurance. And this is a big issue. We don't want to see anyone pushed out of our home. So this is the start. If we can get educated on this and keep organized, we can contact our legislators in Washington and just, this is unfair.
Because they should take some provision for people to be able to pay it somehow. If you're not being able to
Yeah, and actually, this woman here, talking to Diane, is from Senator Chris Murphy's office. So I'm sure she will, I hate to call Kathy out, Kathy Bass, but she's fantastic, and she'll do whatever she can to help, as I know Diane will and everyone else. So this is exactly why we're all here.
After we're done with the questions, we have some refreshments in the back, and everybody will be able to talk with everybody one-on-one. And Carol, you had a question?
The microphone isn't working, so you can probably hear me just as
We
well
can
from
hear you.
here. Ms. Chamberlain, did I hear you correctly that you said something about the premium not being more than 1%?
Value of the property, provision that they put into the legislature.
That exists right now?
Yeah, so a new affordability act, house, he's gonna address it.
I'd like to.
So if you have a $300,000 house, the most your policy would be?
That was what FEMA told us on Thursday.
In theory, all right, when you read the language of the bill, and I would really like to know how FEMA is going to execute that, because the language in the bill around that specific section, it's really mushy. It says FEMA shall endeavor to charge no more than 1%.
That's why you have us sitting on.
So that's where these folks, you really got to lobby hard on that to make sure that, FEMA executes that.
How would we lobby hard for that?
Right here.
Right here.
It just, through the representative from Chris Murphy's office, with us. But that area of the bill, believe me, when I saw that area and I was reading that language, I was scratching my head and I'm like, shall endeavor? I mean, that's the squishiest language I've ever read in legislation.
That sounds an encouraging piece of information.
Well, and let me just answer that with one thing. These 4 FEMA representatives were sitting in front of a group of a few hundred of us realtors, the leadership of the whole country. And this gentleman, not more than once, because trust me, we all said the same thing. The minute he said that, we all went, really? Is that what that meant? So he repeated it multiple different times. I think they're going to be hard pressed to backpedal on that with us sitting on top of them, but we're going to do our darndest to stay on top of it, and that's one of the provisions we're watching.
That's very encouraging. I mean, when you're in line to
I can't promise you everything, but I can promise you that I won't shut up about it.
Does anyone else have a question?
I'm a little fuzzy on this elevation certificate. I got moved into the AE zone in Westbrook, and when I called the surveyor, my house sits several steps, up to get into it. He said that because I have a basement, that doesn't matter. So he basically kind of said you're going to be wasting the money to do it. It's not a finished basement. But he said for mechanicals are down in the basement. Is that wrong? Because I thought I heard you say.
Not true. The biggest thing that they're going to compare is the flood elevation to the lowest, what they call the lowest adjacent grade, or lag. If you go on the elevation certificate, there's a spot for that. They're looking if your ground elevation, the lowest point touching your house, is above that flood elevation. Does that make sense? You could still have a basement. How old is the house?
50s.
Okay, there you go. You could still have a basement. They're looking for, doesn't matter if it's finished.
I guess I'm asking, the realtor said that, how did she say that? You could be paying money that you don't necessarily have to for premiums if you don't have the elevation certificate. So I'm wondering, how does this help me? Because the surveyor is saying it's not going to help me.
It's a different question.
What I was referring to is the elevation certificate is important for you with a house your age because it is the document that is going to decide what's the maximum premium you should be charged for that home at that elevation. And the basement issue is another issue. I have to carry my furniture up every time it rains. But at the end of the day, your basement coverage, and it depends on your house, and I'm not an insurance person, so you really do need to find a good insurance person to chat with about this. But like in my case, none of my personal belongings are covered below grade. My living level, yes, in the living room, but that big TV, the big couch, the ping pong, I gotta carry it all up every time the flood comes. Because if it floods in my house, and thank God it hasn't yet, I've come close, those things aren't covered. What's covered is my mechanicals, that's it.
Thank you. Sir?
I have a side question to what this woman said back here about the 1%.
is what they're ultimately want to charge us. 1% of what? The property value or the dwelling? Because the land's always going to be there. They're not going to.
What are we talking about?
The
1%.
I think it's again, that's what's not really, there's a lot of unclarity, I should say, around that. I believe it's around the house value, and the thing is, the maximum amount of coverage you can purchase is $250,000. So technically, the maximum amount should be $2,500. But again, I think.
So can you say, okay, I can rebuild my, I'm a builder, so I can rebuild my building for $40,000 or $50,000 just to say. Can I just buy that amount of insurance? Is that what they're going to let me do?
Well, do you have a bank? Your bank might have something else to say about it.
No, I own it outright. So
Yeah, if you only want to purchase $40,000 worth of flood insurance, you can purchase $40,000 worth of flood insurance.
it's just a seasonal property. So
No, yeah, you can do that right now. Yeah, you could just.
I can do that right now?
Yeah.
But he made a good comment that
That's right, that's what I asked him. He said he has no mortgage. And I said, if you have no mortgage, you can do whatever you want. You can go without, or you can say, I want to get at least $40,000, and you're good.
next question, sir?
First of all, I've been underwater now for 30 years. I have a piece of property on the water for San Francisco. I've never heard of an elevation survey till today. And where do you get one? Who do you ask, and how do you know if it's correct or not?
And you go to an engineering firm and they survey the property.
There's an engineer. You can send 4 surveyors who give you 4 different answers.
Technically and hopefully they wouldn't, but yeah, it's a fairly accurate.
Yeah, the thing is, as I said earlier, there's a ton of education that has to happen with agents, with surveyors, with the public in general, and I
Can
think.
you use the mic, please? I can't hear you.
As I was saying earlier in my presentation, I think there's a ton of education that has to happen with agents, with surveyors, with the general public, because I think everything that's happened with Biggert Waters and the Homeowners Affordability Act has really put a magnifying glass on the lack of information that's out there, or how FEMA and ourselves, as public representatives for you, working with you, need to do a better job of getting out there and educating the people. And I think this is, Diane and I have been doing this, I've been going around, we've been trying to do more and more of this because I see it, and I know even in our agency, in the past it's always like, oh, that's a federal program, we don't want to get involved in it. But I'm even telling folks in our agency, we need to have a knowledge of understanding what NFIP is about, how it works, and at least be able to direct people to the right sources where they're going to get good information.
Next question. 1 second.
Any licensed land surveyor on the coast should be able to do an elevate. No, I'm getting shaky heads. Ask them if they've done it before.
I hired one and I have the paperwork and elevation certificate. If he wants something, the number.
Okay.
I have that.
That's good. I mean, you want a reputable person who's done it before, you don't want... And she's... No,
I don't know if you have a computer, but if you do, you want to go to Realtor.org, because bottom right, look for the little NFIP house that's floating on the water. And if you click on that, I think it's going to answer a lot of the questions you have. And I will tell you this much. This is an issue that this association, my association of realtors, has made its #1 priority. And we intend to work with the municipalities. We've already funded a grant in Milford to work on their community rating system, which is the system that drives your premiums for those NFIP policies. And we're working with them because our hope is that when that study is completed in July, it will become a model that we can then take up and down the shoreline into any municipality and say, here's how it's done and let us help you do it. And so from there, we're also working to put together some readable, understandable guides for homeowners, buyers, sellers. We're looking to get that stuff done this year as well. So, I mean, Connecticut's really taken a lead on this. I mean, it is a federal program, but I have to tell you, these guys, everybody stepped right up when we realized what was happening. And so you have a lot to be proud of. There's a lot of states out there that are still kind of reeling with all this.
Thank you. Next question. Sir, in the back.
Yeah, you said a couple times that your mechanicals were covered under the FEMA program, and my FEMA insurance clearly states that the foundation is not covered, nothing in the house is covered, and the mechanicals are not covered. Homeowners doesn't cover any damage for flood. No. This is my FEMA policy.
That's the opposite. That's the only things that are covered. Yeah.
It's the opposite. It's the only things that are covered.
My FEMA
Finishing is not covered.
My FEMA policy does not cover mechanical.
I think it's,
Does it cover what?
Mechanical.
the things you're listing though are the only things that are covered in a basement area, is the foundation
I don't
and,
have a basement.
okay, then what do you
I'm
have?
on piers.
Okay, all right, so you're in a V-zone house?
No, 3 square feet of my house is in the A zone.
Okay. It
On
still
a
should,
river, on a river, on Ironworks Road. It's
okay.
like
So
miles.
is it a crawl space?
No, it's open. Oh, I mean, you can crawl.
So it's on total open piers?
Right.
Well, then, okay. So it's still gonna cover the piers, it's gonna cover, is there anything underneath that?
Is that where your mechanicals are?
Is that where the mechanical?
No, my furnace is in my attic.
Okay. Then it's not gonna get damaged. I'm trying to figure out what the issue is then.
Well,
The piers would be covered, that's the foundation. If something buckled, it would cover that, but then there's no mechanicals down there anyway.
well,
You're good there,
your
it's up
block,
to
the
you.
whole house is gonna come down, so that.
But it will cover the piers.
What?
It will cover the piers. It is gonna cover the foundation, that's like the only thing it does cover.
Right, but does it cover mechanicals? Was it supposed to cover mechanicals?
It is if you had them down there. If you had, say, a furnace, like a lot of people would have their furnace down there, their hot water heater, that's about all it's gonna cover.
But if you
Are you trying to say if the piers get taken out and the whole house collapses? Is that the question?
Why, I mean, if I homeowner insurance and it covers everything in the house, but the flood insurance, what is it supposed to cover? Because I've read the policy multiple times, and there's millions of exceptions in there that they don't cover this, they don't cover that.
You're right.
I pay $900 a year for homeowners. I pay $1,900 for flood insurance. Because I have a house, they charge me $1,400 for the house. There's a separate structure, they charge me $500 for the structure. And
It's gonna cover the foundation, so if there's nothing under there, there's nothing to cover. So if there's no furnace under there right now, obviously it's not gonna cover something that doesn't exist. But if it does, it will cover the foundation, so if one of the piers came out,
I'm talking, there's a total loss in the house. Are the mechanicals covered?
yeah, it should be, yeah. Yeah.
Up to 250, right?
I would, do you have an insurance agent that you bought the product through? And have you spent time sitting down with that agent to go through that policy in detail?
I've read that policy in detail, and that's why I'm surprised, because it's very clear in my flood policy that my mechanicals are not covered.
That just baffles us because that's exactly.
I think, Nate, what you're trying to say is, in other words, your mechanicals are in your attic.
Not my AC unit.
Okay, all right. So anything that's above flood elevation and wouldn't get flooded isn't gonna be covered. But if you have anything that's below, so say it's that AC unit, would be covered. Does that make sense? So it's gotta be damaged by flood. So if it's damaged by wind, it goes under your homeowners.
Yes, I understand.
Okay, there you go. Okay. I think he's right. I think you may wanna sit down. I could also give you a name of the FEMA insurance specialist in Boston, if you'd like that in his phone number. And maybe you want to have a discussion with him, a more in-depth discussion with all your paperwork in front of you about this. Maybe that would help too. How's that?
Right.
Okay.
Miss, you were next.
I did. As a secondary homeowner, are we better off? Is there any reprieve with the latest legislation? No. I mean, it's going to keep going up 25% a year.
This is the beginning of it, and that's what we're doing now. We're trying to bring you up to speed on some of the future issues so that you can know what's going on. And this is.
So if it's 2,000 now, and then it's going to just keep compounding on top of. So would we be better off to pay off the mortgage and then just purchase as much as we want?
Exactly. If you were able to do that, it would be cost effective, but not a lot of people can do that. And another thing, I just want to make a comment, George. You mentioned that we talked about a $250,000 cap for the dwelling. So there was. there was an issue of a purchase, a seller in Branford. There was a house, several $1 million house, and there was a $60,000 a year policy. And the argument was that if the owner was going to purchase a $60,000 a year policy and it only pays out $250,000, people need to realize that if you have a house that's worth several $1 million and you're paying a certain amount of money, that these policies only pay a cap of $250,000.
That is true. There are markets out there called the E&S markets, excess surplus lines markets, though, where you could buy excess coverage over that. There are also companies, Chubb, Fireman's Fund, AIG's has a high value program where they offer excess coverage over your flood. So if you had $250,000 and you had a $3 million home, you could purchase additional coverage for that. So there are markets, Chubb offers a policy, and so does AIG, and so does Fireman's Fund. They'll offer first dollar. So you could go to those companies, and you really find this in the higher value market. So folks in the higher value market might go out and purchase a Chubb policy and then purchase $1 flood policy from Chubb, or they might purchase something from FEMA and then purchase an excess policy. But there are options, and there's ways that you can get coverage above that.
Just so that's clear. Sir?
What's not clear to me is that this guy's paying $70,000 for insurance, and he's only going to receive $250,000. Yeah, okay.
Caps out at
This other
$250,000.
guy over here, he's only paying $20,000, and he's still going to get $250,000. Why? Why does this guy have to pay?
It's risk. I don't do the NFIP pricing, but if I was an underwriter and in my former life, and when you're looking at a risk, you're looking at, you have a person that's living maybe 20 feet from the water, and there's maybe 3 feet of elevation between him and the water, and then you have another house down the street that's probably 50 feet from the water, and they have 20 feet of elevation. So the company's going to be looking at that and saying, this person is going to pay less because they don't have as much exposure as that person is living right on the sound, where they're more likely, the frequency and severity of loss is going to be greater.
So these are the kind of things, when I first got involved with the task force, I thought I knew a little bit about this issue living here, but these are the kind of things that I wanted to discuss tonight. I feel that they're very unfair. We need to be organized to see what we're getting ourselves into. And there's a lot of other things that are coming down the road that I've read in the bills. There was one issue that was looked at where if your house was damaged and it had to be moved back away from the water, there's an issue if there's no place to move it to. This one bill, you wouldn't be able to move it. They would not let you rebuild it. There was another issue with seawalls. When you go to put a seawall in front of your home, they found that when the water hits the seawall, the energy goes to the side and it affects your neighbor's property. So that was an issue with people that put seawalls in front of their homes. So there's a lot more coming down the pipe to do with our area in this part of the state. In fact, as I said before, 64% of our state is affected by flood insurance. So it's a big issue. Do we have any more questions? Miss? We'll get you over there.
If the lender's interest is substantially less than $250,000 cap, can they still mandate that you have to get the $250,000?
Well, the $250,000 is the cap, the maximum that it would pay.
No, I know that, but I know that my
loan
lender.
amount. So if you had a loan amount for $100,000,
Yeah.
the bank will probably only require that you get a loan for the amount of the loan.
So 100,000.
So 100,000.
Oh, that's good, because I thought that they were mandating that I had to have $250,000 a month, the maximum coverage.
No.
Even though they didn't have interest.
The bank's usually going to want to cover its loan, so
Makes sense.
they'll require you to cover that loan amount. You should consider that, you're covering that loan amount, but you're gonna wanna cover anything over and above that too for your protection.
Right, absolutely.
Gentleman in the back that had a question, 3 people in the back. Sir?
Yeah, Michael Galway, 32 Nod Road. I'm speaking for myself along with a few of our neighbors. I have commercial property down there that I'm paying $2,000 for flood insurance for. My question is, the name Storm, because of Amtrak, has one culvert that stretches for probably a mile either way short of downtown. The water from 2 streams bordering our properties all has to go through this one 3-foot wide by 5-foot tall, 130-foot culvert that's 90% blocked. This is blocked and called blocked by Amtrak's own employee. Now, if our property floods, like this last storm, we had 3.5 inches of rain overnight, the water literally came to the top of Nod Road. A major storm is going to flood out a bunch of homes up there, all because it can't exit. Now, we've been battling Amtrak for 5 years. Joe Courtney's office has gotten involved. If that property or our properties flood, under FEMA and what we're paying for, who's going to pay for it? Who's responsible? Because I could see the insurance company is going to sit there and say, they neglected the culvert. The flooding is not as a result of the storm. It's a result of Amtrak failing to clear the culvert. Where do I go with this? I've gone every place with this.
I'm going to put the complaining part back here. The part about the flood and who's responsible, they're not going to look at that culvert in the sense. They're just going to see, did a flood occur? A flood is if 2 or more properties are flooded, inundated by water, over land somehow or title. Now, I give it back to him for complaining about answers.
I understand your point, but I'm paying flood insurance to prevent against storms. My property's going to flood because of Amtrak. My rates are going to go up, not because of the storm, but because of Amtrak.
Yeah, and so we'll let Rep. Vicino answer that question because I think it's really working back through your legislators. But also you said your insurance company, but keep in mind, some companies, you might have the Travelers or a company that they service the NFIP policy. At the end of the day, always remember that NFIP policy, even if the Travelers is the one that may have issued paper on it, it's still the NFIP federal program. And a lot of people mistake that and they think it's Travelers that's dealing with that. And it's really the NFIP policy and that's who's responsible for it. Travelers is just in an agreement to service that for the NFIP.
I mean, even my agent understands the issue that's up here. They call it a tidal pond, but the tide can come in and out 3 times before the water ever gets up to this place to make it move. But it's going to be blocked with the storm. It's going to cause a lot of grief.
Before you leave, you could get together, Senator Murphy's liaison, pass your name over. It's an Amtrak, it's a federal issue. And we could look into it to see what's going on in that area. So after we're done, we'll get together.
And one more quick question. What are the banks involved in all this? How are they involved? Because my bank has basically told me, even though I proved my elevations put me above, they said, we don't care. Literally, that was the statement made to me on the phone. We don't care.
It might be that you need to go through the formal map amendment process. Is that what they were trying to tell you? Is that?
No, I told them I would do that, and the end result was, we'll take it under advisement, but we really don't care.
I think it really comes down to the bank is like, saying we're going to be loaning you X amount of money, and we feel that you're in a flood-prone area, and we want to make sure that that loan that we're giving you is being secured.
So if I moved down 5 feet over the floodplain,
yeah,
they don't care. It doesn't matter.
Well, your flood insurance rate will be significantly lower if you've built up about 5 feet above the floodplain. So you wouldn't be paying as much, but the bank can still say, yes, even though you're 10 feet above the water, we still want you to have flood insurance. But because you've elevated, your rate's going to be significantly lower than if you did nothing.
Did someone have a question, sir? Anyone back here? Lady in the back. Oh, there she is. Your question, miss?
Yes, I just was recently, my house was put into the floodplain, in 2013. And we had a elevation study done, and the elevation was, below what FEMA said, but he told me that the FEMA map was bogus, and he told me it was gonna cost me $10,000 to $20,000 to prove FEMA wrong, and I may not win in the long run. Is that true?
That sounds like a lot of money for
Oh,
your
it sure
survey.
does.
That's the government.
I think I would look for another surveyor, to be honest with you, to start with.
That's not a true statement.
I'd find another survey.
I don't, that seems like an exaggeration, Steve. Is there anyone else that had any questions? Miss?
I live in Westford on Route 1, and the sound was gonna come skirt my neighbors and up my driveway and take half my house away. So when I hired someone to do the certificate, my rate tripled from what I was paying. From what we were rates.
That is the double-edged sword. Unfortunately, food, you're in a worse place. It is, you have to have the certificate, otherwise there's no cap.
But if I bought my front door, I'm gonna be fine. Well, so if I take off half my house, my yard will still be in flood zone. It's
only the structure.
Yeah, but my house is on my property's going to flood in the back, so I'm still in the flood zone.
Oh, the flood zone, it only matters if your building structure is in the flood zone. If you have 10 acres and the very corner of it floods, your house isn't necessarily in the flood zone.
See, I don't understand how it's going to go up my driveway.
Yeah, but not if you have a mortgage with the bank. But the flood zone does not go into my barn, and the bank basically covers up the flood.
And if you call the mortgage, and if you call FEMA, and if you call the bank, they have you calling each other. I spent 5
Miss, after we're done, if we could take a look at that elevation certificate, that would be helpful. Because, thank you. Did anyone else have a question? Miss?
I heard that they were going to be redoing the flood maps again. Is that true? So this is for a period of time.
They're doing a study to make sure that they're accurate. They're working on verifying the maps that are being asked to do.
And I also heard that an elevation certificate is only valid for a year, that if they expire.
No, the land doesn't change. I haven't heard that.
It may be invalidated if you got a new map, it may be invalidated if you did some project at your house and did weirdo things to your land. It's only good for that snapshot in time. There is a date on that form, but that's like the date. It's not like it expires, it's just the form may change. They have the right to kind of change the form, that's all it means. So sometimes people get confused because it says expires on whatever date. The form is still good until some, again, thing that potentially changes the data on that form of being invalidated. Does that make sense? No, the storm doesn't matter. It's really only if there was a remapping. Or again, you did something to the house, or like say the house, you tore it down and built a new house and all the elevations are different. Well, then obviously it's invalid. Or you regraded the yard and it's invalid. Something like that. But sort of a little date on the form.
Did everyone get a chance to ask a question? I want to make sure everyone had a chance. If not, I would like to thank the speakers that came out tonight on their own time. Thank you very much. Appreciate it. And I'd like to thank everyone here. We're going to have some refreshments in the back. So if you have any questions, the speakers will stick around for a few minutes and we can answer some questions. Thank you for coming tonight.